All right, and I want to start this discussion of this small case. Okay, the case that I am going to discuss here is that of a direct marketing company. Direct marketing here means the company actually reach outs to the customers directly. It sells its products directly to the customer. It doesn't go through a distributor retail channel, okay, but the company produces and sells directly to the customer, and that's known as direct marketing. Okay, you know, e-commerce is direct marketing, and you know, when you subscribe to a magazine or a journal, you subscribe to Harvard Business Review, The Economist, or the Madhubhumi. These are all subscriptions, or these are all products delivered directly to a customer, and of course they will be sending to you promotions. Okay, promotional investments or expenses are part of direct marketing. Okay, so ABC, let me camouflage the name of the company. ABC is a direct marketing company which sells its products through catalogs, meaning it has list of customers, existing customers, and it reach out to those customers directly for increasing their sales, okay, and of course promoting its product. Okay, so that is customer retention and customer expansion, and it also tries to acquire new customers, okay, which is cost on customer acquisitions through, you know, through programs, okay, through programs like reaching out to the customers with materials or catalogs, etc., and offering, you know, products or services free for some time, etc. Okay, these are all part of the tactics that is followed by direct marketing companies. So we have a company of that sort which we are discussing now, and look at some basic data that is available. Okay, let's look at some data about this direct marketing company ABC, and look at the left hand side of the spreadsheet. We are given some basic data. Okay, so as I said, this company reaches out to its customers, potential customers as well as existing customers, by mailing catalogs. Okay, so if it has to mail a catalog, there is a cost involved. Okay, that cost involved involves the administration cost as well as the mailing cost. Okay, and that together is given here as rupees 5. Okay, all values are in rupees. Okay, so this is rupees 5. Okay, well, that is their value. Okay, and then there is another cost in mailing catalogs, that is, you need to get the address. Okay, especially if it is for customer acquisition. Okay, there is a one-time cost of getting the address of the customer. Okay, so you have to buy a database, and the databases are usually bought from database marketing companies who sell information about customers, and sometimes they do analytics. That's something that we are going to see in classification. So customers who are likely to buy your product would be available with this firms, and that has to be bought at a cost. So the cost of one record is 0.2 or 20 paise. Okay, so you have to buy the contact. Okay, so total cost of mailing a catalog is the cost of the address plus cost of the catalog and the mailing expense, put together 5 rupees 20 paise. Okay, that is the value. Now at this point we are discussing reaching out to a potential customer or a prospect. Okay, and now when you mail catalogs, a customer or a prospect, not a customer here, a prospect may respond, may not respond, and therefore there is a response rate, and here the response rate from historical data is shown as 4%. What does that mean? That means if you send your catalogs to 100 prospects, 4 people respond, 4 people subscribe, or 4 people become your customers. So that shows the response rate is very poor, and for getting 4 customers you need to send 100 catalogs, okay, that is understanding, or to get 1 customer you need to send to 25 people, okay, that is also another interpretation of it, okay. And therefore acquisition cost is nothing but the cost of mailing divided by the response rate, okay. So that we get by dividing 5.2 divided by 0.04, and that is the acquisition cost for 1 customer. We already see that to get 1 customer you need to send the catalog at rupees 5.2 to 25 customers, and that is the value that you are getting here as 130, okay. And 130 is the acquisition cost of a customer, okay, that is one time cost, okay, we calculated it, and we know that that is required for the formula acquisition cost, okay, AC. Okay, now again from historical data, it is known that average order value of a customer, okay, if a customer responds, on an average the customer places order for 500 rupees in 1 year, okay, the average order value is INR 500, okay, and that is the price a customer, in other words, in terms of our formula, that is the price a customer pays in 1 year to the company, that is a positive cash flow, okay. And again there is a profit margin, okay. So what does it show? If 500 rupees is received as a as revenue, the profit is 20%, okay. And I think I used the term production cost sometimes when I was explaining the formula for CLV. That is not very accurate, because production cost of the product is not what I meant there. It is the production cost of the catalog, okay, the marketing material, and the mailing cost and database cost and all that. That is about the marketing cost. But the cost of production of whatever product you are selling, and the employee cost and all that is factored in calculating the gross margin, okay, that is a separate calculation, okay. So if 500 rupees comes as revenues, 20% of it is profit for the company, okay. So that means 20% of 500, which is 100 rupees, okay. So when a firm gets 500 rupees from a customer, it's making a profit of 100 rupees, okay, because profit margin is or gross margin is 20%, okay. And the other data that is given is number of catalogs sent per year in the first year, okay. So let's see, let us keep that as the rate for all years. So then you see that a company or this firm sends a catalog every month. It's a bit traditional, and you can send this through electronic channels, but there are challenges because of the attention problem today, and also it may get caught in the spam, etc. So regular mails are still active, especially in direct marketing programs, okay. So and the last item, so 12 catalogs a year, okay, that is a cost that is incurred in the marketing 12 times, okay, whatever cost is incurred in mailing catalog is incurred 12 times, okay. And there is also survival rate, okay. So survival rate is something that we discussed already, but here in this problem, survival rate has been estimated as a fixed rate. That is, if there are 100 customers in this first year, okay, the 100 customers in the first year, the 100 will become 75 in the next year, 75 will become 56 in the third year, 42 in the fourth year, or 32 in the fifth year. Or you can see in the formula, we are multiplying the 100 by 0.75 and 0.75 every year, or the probability of a customer being active in the first year is of course 100%, or 1, second year is 0.75, third year is 0.56, and so on, okay. So expected value is based on the probability of survival of the customer, okay, and that is given as 75% as a fixed rate, okay. Okay, so this is the data that is available to us in calculating the CLV, customer lifetime value, for a customer. Okay. Now let us see how this information together can be used to arrive at a figure called CLV of the customer. Okay. And in this particular calculation, we are going to use a time horizon of 5 years, okay, or T equals 5. Okay. And here is the first year. Okay, let's look at how we can arrive at what is the cumulative profit per customer in the first year, which is the bottom value. Okay, margin on each purchase, we have seen that. Okay, 500 rupees is the average order cost, and that multiplied by the this 500 multiplied by 20%. Okay, that is 100. Okay, so 100 rupees is what the price that the not the price but the profit that the customer brings. Okay, survival rate in the first year is 100% or 1, and cost of mailing catalogs is okay, cost of mailing, cost per catalog is 5.2 per customer. Okay, and therefore in the first year you incur a cost of 5.2 into 12, okay, which is shown as 62.4. Okay, so 12 times the catalog is mailed, okay, and therefore it is 62.4, and it includes the database cost and the sort of the cost of the catalog, okay, and the mailing expenses. So 62.4. Okay, total expected profit per customer in the first year is, of course, the using the formula. You can see how this formula is applied. This is F3 is your profit, that is 100. Give me a moment, I will get back to this. Okay, so we have discussed up till cost of mailing the catalog, and now we are going to calculate total expected profit per customer, and look at the formula. Okay, look at the formula. 2 into F3 minus F5. Okay, 2 into F3. What is F3? F3 is margin on each purchase. Okay, and why is it multiplied by 2? Because in the case it is given that a customer places 2 orders in an year. Okay, that is a given information which I did not explain when I was explaining the basic data. Okay, but average order size is 500, but for this category of customers which is discussed in the case, okay, there are different customer categories. This customer places 2 orders in a year, and therefore it is multiplied by 2. Okay, so 2 into F3, that is the profit. So that is the inflow. Okay, that is the revenue, minus F3. Okay, F3 we have already seen, this is the cost incurred, okay, on the customer. This is the marketing cost. Okay, and therefore this is this becomes 125.09 in the first year. Okay, but we have seen that in the CLV formula there is also an acquisition cost. Okay, an acquisition cost is already calculated as in the previous discussion. Yeah, this is 130. Okay, acquisition cost is 130. So 125.09 minus 130 is minus 4.91. We can see that in the first year it is a loss. Okay, because of the investment that has happened in customer acquisition. Okay, the customer acquisition cost actually drives down the profit in the first year. Okay, and we expect profits to become positive from or the loss to become profit from the second year onwards. Okay, so when we move, another element which I did not show you in the formula. Okay, the numerator is explained, 2 into F3 minus F5. The denominator is the discount rate. Okay, 1 plus 0.1, okay. And what is the 0.1? Let me add that here, okay. The interest rate, okay. Interest rate, okay, of capital is given as 10%, okay, 10%, okay. So 10% is the interest rate, okay. So therefore denominator becomes 1 plus 0.1, okay. And indicating that there is a interest that the company has to pay in the first year for the expense that it has made, okay, in the first year. All right, this is understood, and we have calculated the cumulative profit per customer now. And now let's go to the second year, okay. Second year is the same as first year in terms of, we don't have any additional information here, since we are relying on the historical data when we do calculation at a given point in time. So margin on each purchase is 100, survival rate has become 75% from 100%, we discussed this already. Cost of mailing catalog, okay, is given here. I calculated it as 62.4, which is the same as the previous year. But there is an issue here, okay. I must correct myself. Why? Because the acquisition cost is typically in the first year, okay. And when it comes to the second year, you are maintaining the customer whom you acquired in the first year. And therefore, you may be continuing to send catalogs to the customers in order to retain the customers, in order to continue to get subscriptions from the customer, okay, on a monthly basis or on a quarterly basis, okay. Here we have taken the or we assume that the company sends 12 catalogs in an year. Let's assume that the 12 remains the same, okay. So the multiplication factor is 12, but I have used B4, okay. B4 is the 5.2, okay. 5.2 is the sum of 5 and 2, 5 and 0.2. 0.2 is the cost per database record, and 5 is the cost of mailing the catalog. But in the second year, we should not add this database cost because this is already procured, okay. So therefore, I must make that correction here. Instead of B4, I should rather use B2, okay, which is the cost of mailing, producing and mailing the catalog, okay. So I change here it to B2, okay. Okay, and that has slightly, it has become 60, okay, and in all years it should be B2, okay. So I will change that here, okay, and that makes it pretty straightforward, okay. Okay, error corrected now, okay. So now second year onwards, the cost of mailing is only the catalog cost, and then there is no database cost. And then total expected profit is, of course, in the year second from the revenues, the total expected profit is 86.78. And why it is not 125.09? It is not just the change in the catalog mailing costs, but although it has reduced, you can see the profit has reduced. That is because of the discount rate, okay. So you are paying interest for your capital, okay. In the second year, you can see the discount rate has got multiplied, okay. It is to the power of 2, okay, and that has brought down the profit in the second year as compared to the first year, okay. And now, of course, the cumulative profit, okay, of course your cash flow has become positive in the second year, but you have to, of course, account for the negative value of loss in the previous year. So accounting for that, your total profit in the first year per customer is 81.87, okay, and this calculation is replicated from year 2 to year 3 and year 4 and year 5, okay. 100, survival rate has become 56%, cost of mailing remains the same, and therefore based on the adjusted survival rate and discount rate, okay, it is to the power of 3 here, the the returns has, the present value of the returns has subsequently come down. It has become 59.17, and of course when you add that 59.17 to 81.87, your cumulative profit becomes 141.03 in year 3. And of course, going by the same calculations, when you actually further do it for year 4, it actually becomes 181.37, which is 141.03 added to 40.34, which is 181.37. And when you further go down, go forward to year 5, the cumulative profit becomes 208.88. Okay, 208.88. I have put that figure in bold. What is 208.88? This is the CLV of a customer. Okay, the CLV of a customer is 208.88. Our effort here is to estimate the future returns of a customer who contributes to the business in this way based on this data, and whose survival rate is at this given rate. The CLV of that customer will be 208.88 rupees over 5 years. Okay, looks very slightly disappointing. Okay, in 5 years time a customer is going to buy 208.88 as I look at the customer's value today. That looks very small. Okay, well, this makes sense only if a firm is doing a company is doing a volume business. Okay, as in the case of e-commerce, when this is a value per customer, but your customer segment may be running to a few hundred thousands or a few millions. Okay, then you can see the overall profitability, future profitability. Okay, so let's not worry about this figure. Let's treat this figure as given. Okay, and this is something not given. This is something that we computed based on data. And this customer of course belong to a particular category, because survival rate is given for a category of customers. Okay, and a customer in that category, the CLV is 208.88. Okay, this is interesting. Now, okay, when we, so I am here showing some other figures, like earlier we had estimated it as 205.21, and in that case we took the cost per mailing data, cost per mailing for the database cost as well. Okay, when we removed that, of course, the profitability or the CLV increased by 2%. Okay, just leave that. That is very trivial. But once we have a spreadsheet, of course, or ROI spreadsheet, it also enables a decision maker to do some sensitivity analysis, or how the output changes or the response changes when you change a certain input values. Okay, the input output dynamics is of course given in the spreadsheet, but where it is more sensitive, where it is less sensitive, etc. For example, let's do one thing. Suppose the company invests in customer retention, okay, and tries to increase the survival rate. Okay, suppose the survival rate of the segment is, instead of 75%, okay, let me actually correct this figure first. Okay, this is 208.88, that is our base value. Okay, okay, 208.88. Now let me actually make the survival rate, say increase it by 5%. Okay, so let me make it 80 and see how the CLV is going to change. Okay, well, the CLV has now become 239.54, and that is a 13% increase in the customer lifetime value. What does that mean? A 5% increase in the survival rate increases customer's future value by 13%. Okay, so it is not just the double, but it is more than double. I think we discussed this in a previous session where we saw that customer retention contributes to profitability of a business. So this is quite obvious for us here, that increasing survival rate has a very positive and multiplier impact on the CLV. Okay, let me actually take this value back to 75%, because that is our base value, which is 208.88. Okay, now keeping survival at 75 itself, let's see, gross profit, gross margin is something that you may not be able to change, and you don't want to change the number of catalogs sent, but average order value of a customer. Okay, now suppose you invest in recommender systems, okay, and proposes or recommends more relevant products which a customer is likely to buy to a customer, and the customer's order value increases. Okay, from average order value, instead of 500, suppose you are able to make it 600. Okay, and if this customer of course buys twice, okay, instead of 500, if it becomes 600, what is the impact on CLV? That's very interesting. Okay, a 100 rupees increase, okay, in order value has led to 32% increase in the CLV. Okay, so a 100% increase means what? Okay, this is 100 by 500. Okay, so therefore it is a 20% increase. Okay, so a 20% increase in order value results in 32% increase in CLV. Okay, so therefore this is a sort of a simple insight, but it is very insightful as far as investment decisions in analytics is concerned. Okay, you are going to invest in recommender systems by employing experts, by employing in investing in databases or analysts. Okay, it is based on the rationale that customer's future value is going to increase when you actually make strong recommendations, relevant recommendations, leading to increase in customers' buying behavior or customers' contribution. Okay, so that is a sort of insight that you get from this simple exercise. Okay, and let's also look at this. Okay, so the response rate has a bearing on the acquisition cost. Okay, you can see the acquisition cost is 130 rupees. Okay, suppose the response rate increases from 4% to 5%, 4% to 5%. Okay, does it have a what is the sort of impact it has on CLV? Okay, let me make it 5. Wow, that's very impressive. Okay, you can see a 1% increase in the response rate has led to 11% increase in the CLV of the customer. Okay, or a customer that belongs to a segment in my articulation. So a 1% increase in response rate has 11% leads to 11% increase in CLV of a customer. Okay, and that is very, very impressive, and that is why you will see in the next sessions that companies, especially those who are in internet business, okay, doing large volume business, okay, invest hugely in improving the performance of their algorithms. Okay, if response rate can be slightly increased, it has a huge impact on revenues as well as cost. Okay, and therefore this is very profitable, and it impacts the profitability and CLV of the company. Okay, and that is another insight that you can actually derive from this spreadsheet. Okay, let me go back to the 4%. Okay, and Well, I will not change any figure, but we are seeing how sensitive the CLV model is to various inputs. Okay, and we can actually look at the impact of changes in the inputs on the output, and this is insightful for a manager when manager decides on its strategy for marketing. Okay, and it also provides a rationale for a marketing manager in front of the finance group to justify the investment in analytics. Okay, we touched upon business value of business intelligence, okay, in one of the previous sessions, and the hard step for a manager to get professionals in analytics is the conviction of the top management or the conviction of the managers in finance. Okay, they need to provide you funds to invest in analytics. Okay, but they will ask what is the return on investment. Okay, and a CLV analysis, you can see, also helps in building rationale for investing in analytics, in customer analytics, in recommender systems, etc., because you can demonstrate based on data from databases that this is the expected returns. Okay, it is not your intuition, it is not your assumption, or it is not your gut feeling, but it is data that speaks in this kind of an exercise. Okay, so I will close this discussion here, and I hope you got a sense of the importance of customer analytics and also the value of customer analytics from a marketing department level, like customer segmentation using CLV, or categorizing customers into platinum, diamond, gold, silver, etc. CLV can be a value that you can use along with other factors. That is purely marketing exercise. Okay, now from that it can go up till customer equity calculation using CLV. Okay, where the customer's equity to firm value can be assessed using CLV. So it has more a strategic use, okay, in making decisions on marketing investments from a top management perspective. Okay, that is what we see in the case of CLV. Okay, thank you very much, and look forward to meeting you all in the next session. Thank you.